How much do you need to make to afford a home in Chisago County? A couple of things that are going to be really important with this is one, obviously your income pre-tax. That's what the lender is going to look at. Two is going to be the debts that you have that are monthly and reoccurring. Car payments, student loans, alimony, credit card debt, whatever those things are. So those are going to be kind of like the three most important factors when it comes to determining what you can afford. One of the most important things I've realized with a lot of my clients in recent months has been this, is they own a home. They don't know exactly how much equity they're going to take away. They don't know what the next payment's going to be. And they don't actually know when it comes to this of like, they didn't realize that their income went up and their debts went down. Their debt to income is actually at like a 10% debt to income. So when they buy a new house and they go, well, I'm used to this $2,000 monthly payment. There's no way I could afford $4,000, right? Or $5,000. Well, can you actually? One of the best ways to find out is this, is to go, what am I going to sell my house for? After fees, what is my down payment going to be? Then the more important thing to do on that is go, how do I allocate these funds correctly? If you sell your house and you have some debts, maybe one of the good ideas you can do is go, I will take maybe a chunk of this to pay off a car loan to reduce your monthly debt. What you want to look for is, do I have any interest rates currently that I'm paying per month? Credit card is going to be one of them for sure. Pay that off immediately with the proceeds of your house. Car payments can be over that 6%, 6.5% mortgage rate. Pay those off to reduce your monthly debt. Overall, when it comes to living and finances in general, your monthly debts as a whole, regardless of where your mortgage is, if you just have a mortgage, you're pretty flexible to be able to do a lot of things. If you have a bunch of tiny debts that are at really high interest rates, get rid of them and do like a debt consolidation essentially with the equity you're taking from another house. So if you look at what you can do and use it wisely. The other thing you can be able to do with the equity from your last house is this. We talked about this last week, is what is one of the better things you can do to be able to reduce your interest rate right now?
A couple of things you can do is buy it down is an option. So you buy discount point or you buy points to buy your rate down. There's different loan products out there, such as an ARM loan. A 5-1 ARM is what they call it, or 7-1 ARM. So your interest rate will be fixed for 5 years, generally at a lower rate. And then after 5 years, it would increase. Each year they would do an incremental increase depending on what the market rate is. Sometimes it's going to be lower, sometimes it's going to be more. But that is also a good thing to do to help with if you have that extra money, you can buy your rate down potentially.
So I think it's really important to understand what are the options that I can do with my equity to use it wisely when moving into the next property. One of the best things to be able to do that people don't realize is this. Can you find a property that needs some updates? Do you take half of the equity from the house you sold, put it into that house, do updates with it, take the rest of the money down for the down payment, and then what you can do is, let's say you're still under that 20%, so you still have PMI. Now a year later, you call your mortgage company to do a new appraisal on the property when you've put 50 grand of work into it, which is added probably, let's hope you just did smart work on it, and it added $75,000 in value. Now here's a way you can get a new house for 5% down, hold cash back, use it wisely, and get rid of mortgage insurance from not having to do anything else, right? Without actually having to put the 20% down to it.
That is something both you and I did when I purchased my house. It needed some work. It didn't have to have it, but it was something we had extra cash, but it was, let's just put the minimal down. Let's do the updates. Yes, I paid private mortgage insurance for a period of time, but then all of a sudden it was, I had did my updates enough to where it increased my value enough to where I had 80% loan to value and was able to get it reappraised and got my mortgage insurance reduced. And then, if I still had some cash left over, so then I also took that extra cash and put that on top of the mortgage balance and brought it down, which is called recasting your mortgage. So it didn't change my terms of my loan. They took the extra I put down and said, hey, your new payment now is X because you put this amount down. Generally, they let you do that one time with, I want to say it's around $20K or more. They'll let you recast your mortgage.
Doing that currently guaranteed rate is you have to do at least a $10,000 principal payment, and it's $500 to do it. You can do it one time, and it'll recast to get a new monthly payment for it. So understanding what you can do with that equity, right? When you sell a property, let's say you don't have a property to sell and you have 5% down, which on average for an average sale price in Chisago can be $385,000. So that's about $19,000 that you have. So you have $19,000. You can cover the entire down payment for a purchase of a house. Now, the most important thing to be able to understand is, one, is the bank going to going to tell me what I can afford and what I can't afford, right? A pre-approval doesn't necessarily do that. They're looking at it from the ways of risk management to go, if you're at 45%, you're most likely not going to foreclose, right? But where is the payment of, I don't want to be house poor? So a lot of recommendations will be somewhere in that 30% to 35%. If you can keep it below 30%, you're in an amazing scenario.
Right.
If you're a first-time home buyer, I doubt that's going to be able to happen. Also realize when people first buy houses, you might be at higher debt to income than you are later on down the road. Your income's going to grow. You may be able to pay off debts. And also you may be able to refi. I think that's the thing that people don't realize is when people first buy that house, they're probably higher on that debt to income. But when they're in it for a few, 3, 4, 5 years, that debt to income typically ends up reducing for those 2 or 3 reasons. So the best thing you can do is be able to go online, right? And we'll have a link below here for our affordability calculator to show, hey, here's what our income is. Here's what our monthly debts are. What a payment are we at that 30% debt to income? Or when are we above it? What will the bank say yes to? What would my financial advisors say yes to? And what would be amazing if we could fit in below that? So understanding those 3 things. 1, how much down payment you have cash on hand, right? Especially when it comes to equity, you know exactly what we'll take away from it. 2, how do we allocate those funds correctly into the next property? Because it doesn't always make sense to take all of the equity you have from your last property to put in the new one. There are better ways and better debts to be able to pay off rather than having it on directly to the loan. So understanding how to use those funds. 2 is understanding, hey, what is that monthly payment that we are comfortable with? Then go from there to go, what price range are we in and what's the best option I can find? And if all those 3 things link up to go, this house was good enough for us to move, this makes sense, then that's when you say yes. Right. And only then, actually, to be honest with you. So always just look at those things. I think the biggest thing I'm realizing right now with everybody that's in their 3% interest rates, right, is going, man, our payment, we love it. I'm like, yeah, you and everybody else. It's amazing, right? But you don't love your house. At some point, you're going to have to move. Could you do it now? Should you wait later? What can you afford? And I've had it 3 times this year, legitimately 3 times, where somebody was just casually looking and they go, oh, I didn't realize I had that much equity in my house. I didn't realize my payments would actually be this. I didn't realize that's actually still comfortable for our lifestyle that we live. And it does make sense and that we should do it. So understand, I think, from clarity of understanding all the numbers that you have of what's affordable, what's not, what can you get. And if those things align, then it's what time makes the most sense for you. So click the link below. We have a free affordability calculator just to give you a gauge of where you're at. If you ever need to know, hey, what's our house worth? Reach out to us. We won't come to your house. Give us your address and we'll help kind of put together all those numbers with a net sheet to give you at least a somewhat of an idea of what you might be taking away. So you can plug that into the affordability calculator to give you an idea of what might work. On the other side of that too, if you can tell us a little bit of what you're looking for, we'll give you the options of, hey, this might work best for you, or here's the price range I think where those things are. And if all those things align to a yes, then maybe it makes sense. If those things align and go, hey, the house that I can get here is way worse than the house I have right now, then make it a no. That's totally fine with us. So click the link below to help you kind of understand your financial situation of what you can actually afford.